Good morning, Bitcoiners. Hello, and welcome back to another edition of your Bitcoin Economic Calendar. I'm here joined by a very special friend this morning.
How's it going, everybody? Thrilled to be with you today. I'm Adam, co-founder of Ledn, and we're here at our brand new office in downtown Toronto, just on the leading edge of the financial district.
And we're very excited to have you here today. As always, we have an excellent show this morning, and we're going to get into it right after this. All right, so after that great intro, we're going to break down the main topics we're going to cover today and get right into it. In today's issue, today is Tuesday, February 15th, and today we're going to be covering crypto exchanges which spent over $40 million in Super Bowl ads last weekend. We're going to break those ads down and a couple of other insights from that. Additionally, we're going to talk about a very busy week ahead in terms of Fed activity. The Federal Reserve is essentially out in full force on the media this week, and we're going to break down who's speaking and when. And last but not least, we're going to touch on NFTs, which are seeing some green in a sea of red. So lots to cover today. Grab your coffees. It's going to be a great one. And we start as we usually do with Bitcoin. We see that last week, Bitcoin finished down 81 basis points, and we see that it is currently trading this morning at $44,230, up 5.6 or 5.06% so far for the week. So pretty positive week so far for Bitcoin. Among the main news that we want to cover today is the fact that 4 U.S. exchanges presented Super Bowl advertisements on last Sunday evening. This represented an approximate total advertising spend of at least $40 million based on public reports and estimates. Super Bowl ads cost an estimated $6.5 million for a 30-second spot for this year. And the same ads typically cost between $1 and $2 million to produce. The number of production costs could be much higher or lower depending on the complexity of the ad and the cost of the talent. As you can see, we saw some ads from crypto companies over the weekend featuring Larry David, very famous comedian, LeBron James, the most famous basketball player, and Coinbase opted for a QR code that gave people free Bitcoin. We're going to break down a few others shortly. Now, the weekend's crypto ads highlight a few things. For one, it shows just how fiercely competitive the US market is becoming for crypto exchanges. Interestingly, none of the advertisements mentioned the word Bitcoin. Most use the word crypto. There was also no mention of the problem that Bitcoin or crypto solves, only that they are the future, as it was mentioned in the ads. Most of the ads had a general theme around not missing out, and one referenced taking your own shots, and another one even mentioned to the moon. Considering that the advertisers were exchanges that list dozens, if not hundreds, of crypto assets, it makes sense for exchanges to encourage this type of behavior. The ads had very high production value and brought on A-list celebrities and athletes. It was a signal that crypto companies now have the budgets to fight with the big boys of advertising. Now, while there is certainly a lot of money to be made from Americans trading in and out of crypto assets, it would be very refreshing and encouraging to see some of the budgets going towards celebrities, athletes, and Super Bowls directed at education as to why Bitcoin and other digital assets have gone up in value. Over the long run, investing in education should have an exponentially higher return on the investment to the companies and to the societies in which they operate. So moving along from the Super Bowl and moving into more sort of Bitcoin-centric and market indicators, let's take a look at some forward-looking market indicators for Bitcoin. For one, we take a look here at the perpetual swaps funding rate, as we do often in this publication, and we can see that the funding rates are actually basically back around 0%, which is an encouraging sign, given that this basically signals that leverage investors are in a more balanced position. They are not overly long or overly short, which helps reduce volatility in the short term. So this is a positive in terms of volatility for the week ahead. So now, additionally, let's take a look at the futures curve for Bitcoin. And here we see that outside of this CoinFlex outlier, what we're seeing is that the curve is actually quite flat. It's basically pretty much flat all the way until the March expiration. And what this means is that Bitcoin for future delivery, Bitcoin for March delivery, is trading very close to the current spot price. Which means that futures markets do not necessarily expect Bitcoin to go much higher until after the end of March. If we look at the options market, we see some consistent positioning, and we're just going to open that up here briefly. Second. Here we go. So here are the outstanding options. This is the bar chart that reflects the open interest that is on the given expiration dates. And as you can see, historically, Bitcoin option contracts have a higher level of call contracts open than put contracts open. As you can see, the blue part of the line of the bar, especially around the June contract, April contract, even like September and December, they are notoriously larger percentage-wise call contracts than put contracts. However, if we look at the February expiration, the March expiration, we see that they are a lot more balanced. And if you look at February 18th expiration, we see that you now have more puts than calls open for this this February 18th expiration. So that's a disproportionately high number of put contracts open relative to what Bitcoin typically sees in terms of call to put contract balances. So this means that investors are looking to protect against downside volatility at least until the end of February. So more on Bitcoin in our sections further along. Moving over to our analysis of the S&P 500 and equity markets, we see that equity markets have remained under pressure over the last 14 days. So far this morning and today, they seem to have recovered a little bit into this week, but they've already been lower into the session. So they've recovered today, but they had a not a great day yesterday. And they could remain under pressure given some of the upcoming data and news flow that we're going to get into just now. So U.S. inflation as of last week has once again taken center stage after the consumer price index reached 7.5% last week. This is, we're just going to pull up this graph, which was pretty interesting, interactive graph from Yahoo Finance. And this is 7.53%, which is the exact number, is the highest level that the CPI has reached in 40 years, as you can see from this chart. And this development has prompted for calls for the Fed to take action. Now, yields on the Treasury notes were very quick to react to the news, with the US yield curve flattening even more. And we wanted to basically look at what you're seeing here today is this curve right here on this website is the yield curve as it stands today. So what we're going to do here is we're going to add last month's yield curve so you can see the difference between this month and last month, and then we're going to add the year before, so a year ago today. So right now we're going to plop in the January 2022 yield curve. And as you can see, it looks very different, or it looks somewhat different. And now we're going to add the 2021 January curve. And in here's when you start seeing some very interesting details. So the blue line, again, is the current shape of the Treasury yield curve. The black line represents January 2022, a month ago. And the green line represents January 2021, just over a year ago today. As you can see, the curve has been getting much steeper at the front end. So it's from here, it's gone to here. And it starts tapering or flattening at the top. So like once it reaches a certain height, it basically tapers and it stops rising as fast. So it starts becoming flatter at the top. And so what will happen when the Fed raises the overnight rate, which is essentially the furthest point here, they're going to bring this up to 50 base points or 1%. And when that happens, the overall curve becomes much flatter because the base of it gets lifted, and essentially it creates like a plateau on the rest of the curve. And this risk of inversion simply means that the near date curves can become more expensive than the longer dated curves. We're already starting to see some inversions here, for example, where the 10-year and the 7-year are trading at the exact same yield. So that shouldn't be the case. That is essentially almost inversion. And from here, we see that the 30-year actually is trading at a lower interest than the 20-year. So we already see some inversion between the 20 and the 30-year. And we started seeing that actually even as early as last month. But as you can tell, there is no inversion 1 year ago. And we're starting to see glimpses of inversion in the recent months. So again, there was a really good article from Reuters over the weekend that basically says the yield curve has been flattening. Why should you care? And it goes into this idea that when the yield curves invert, history shows us that that typically is followed by economic recessions. So much to keep in mind here. We're going to continue monitoring the yield curve and this potential inversion and keep updating you on any kind of market signals that we see. So in the meeting minutes from the last Fed meeting, the meeting minutes from the last Fed meeting will be released this week. And there are many Fed officials that are scheduled to speak this week as well. All the details of that are coming in our What's Ahead section later today. The other headwind that is facing markets outside of the Fed stance and policy are the geopolitical tensions between Russia and Ukraine. And while it is anywhere or everywhere you look in the media, we thought it was insightful to just see how the market has reacted to other geopolitical events in history. And the graph you have here is courtesy of LPL Research along with data from the S&P and the Dow Jones indices. And what we can see by looking at this data is that since 1941, only 4 geopolitical events have caused double-digit drawdowns on the S&P 500 or in the S&P 500. In most cases, or in most other cases, the average drawdown was less than a 5% drop. Something to keep in mind as headlines continue to soar throughout the week. Now, the big thing to keep in mind, as we mentioned, is the possible inversion of the US yield curve. Let's just go back to this phenomenon here that we're just kind of showing here on the chart. That is to say that, again, just to recap, when the interest on the 2-year Treasury bond matches or becomes higher than the interest rate on the 10-year note, historically, when this has happened, an economic recession has followed. So this is the relationship that many, many economists are keeping their eyes on, and we will as well, and we'll keep you posted. So as mentioned above, there's a series of Fed speakers on cue this week, as well as economic data and some interesting earnings. We'll cover all of that in our What's Ahead section. Moving over to gold, we see that the tensions between Russia and the US and Ukraine have basically sparked a bit of a rally on the safe haven asset that is gold. And we saw that last week, it actually had a pretty great week, up 2.82%, almost 3%, and closing at $18.59 per ounce. There's been a few interesting articles, again, highlighting what we just said, which is that this is a CNBC article saying that the geopolitical tensions have kind of sparked this renewed desire in the safe haven that is gold. And if we look at the chart for gold, we see that there is not a lot of resistance left after breaching this level. There is that 1900. There's some sort of resistance here at the 1900 level, but other than that, it looks potentially poised to move on higher if the trends and the right sort of market conditions present themselves. Again, when conflict fears or rumors start circulating around economies, a lot of investors tend to want to add exposure to gold in these types of environments. And another sort of interesting note from a great macro investor and also an investor, Dan Tapiro, essentially manages 10T, which is the crypto fund that Ledn's most recent investment round. And he is actually a very well-known gold investor. And recently he tweeted that rarely, if ever, does the gold chart look as good as it does right now. So when Dan speaks about gold, typically it's a good idea to listen. So we will keep you posted on the potential action here on gold and how it interacts with the fluctuating inflation numbers as well as the potential future Fed actions. Moving over to our DeFi analysis, we see that it was a pretty rough week in terms of price action for DeFi, with the index dropping over 13%. In the same period, Ethereum also dropped over 6%. We saw that again. That was the week where Bitcoin had a very, very slight drop of 81 basis points. But again, we see that the DeFi index and Ethereum came under much more pressure than Bitcoin. Now, while DeFi tokens continue their downtrend since November, which we can see pretty clearly on the chart here, there are a few bright spots left in the crypto asset world. And one of those is the sector that we're about to show here. And this is the Bitwise Blue Chip NFT Index Fund and the Bitwise Blue Chip NFT Index NFT Collections Index. So they are two NFT indexes that have been created by Bitwise, and the point of these indexes is to really have a basket or collect a basket of the highest quality NFT project assets. So as per this chart here, we can see that very interestingly, the in a month where a lot of the crypto assets have been down significantly, we see that the Bitwise Blue Chip NFT Collections Index actually has a 1 month performance of almost 5% and a year-to-date performance of 9.11%. And we also see that the Bitwise Blue Chip NFT Index still has a positive year-to-date performance, even though the month-to-date has not been as great as the Collections Index. Again, looking beyond just this particular index, if we look at Google search trends, we see that over the last year, there has been an explosion in the search interest for NFTs, and it is somewhat approaching the levels of search interest in Bitcoin this year. So an interesting trend to keep in mind, and we will continue to monitor this. Now, the fact that it's important, it's really, really important to notice these types of divergences in down markets. When an asset is trading green, where everything else is selling off, it warrants a second look. The fact that even a segment of the NFT space is delivering positive results in the current environment is an encouraging sign that high-quality projects continue to attract investor interest. The positive returns that these assets have experienced in the current environment will likely act as a siren call that could attract new investors into the space. So again, we'll continue monitoring these trends around NFTs and other alternative crypto assets. And moving over to our Bitcoin mining segment, we see that on the mining side of things, the most relevant headline that we saw last week was the launch of Valkyre's Bitcoin mining ETF on the NASDAQ. And that's the headline you have on your screen right now. The ticker, which is amazing, is WGMI. So I really, really like that ticker. Valkyre Funds is an investment manager focused on the digital asset space. We know that team really well. And big shout out and congratulations to Leah and the rest of their team. The ETF saw strong interest, as you can see from the article behind you, during its first week of trading. The largest holdings for the fund include Argo, Bitfarms, CleanSpark, Hive, and Stronghold. Something important to note here is that 80% of the holdings are mining companies using at least 50% renewable energy in their mining operations. So very interesting angle that they're taking. Over a dozen mining companies that are already publicly traded in U.S. markets or in public markets in general. So although we have seen several Bitcoin spot ETF applications rejected by the SEC, it was easier for them to approve a mining ETF, which is simply a basket of other already publicly listed companies. So interesting to continue seeing innovation here in the Bitcoin ETF space. Now, outside of the ETF space around mining, there was a very interesting hardware headline as well last week. That was courtesy of Intel. As you know, Intel's reported to be working on Bitcoin mining ASIC chips, and they will start shipping. They disclosed later that they will start shipping their energy efficient mining chip later this year to its waitlist customers. And the waitlist customers include Block, which is formerly Square, and the two mining companies called Argo Blockchain and Grid Infrastructure. So it looks like Intel will introduce the first North American ASIC chip rivaling longtime mining semiconductors dominant players for the industry, Bitmain. So we will keep our eyes on this development, and obviously best of luck, and we hope to see a great chip come out of Intel. And as always, we wrap up with what's ahead for the week. It's an action-packed week coming up, filled with Fed speakers, economic data, and a very fluid geopolitical environment. Tensions between Russia and Ukraine could continue making headlines, and geopolitical tensions typically make energy prices rise as countries try to secure their energy independence through the potential conflict. This has made Europe's inflationary woes worse during an already cold winter. We know they were suffering already from very high energy prices, and this is not going to make matters any easier. So this could keep markets unpredictable in the near term. There are 7 Fed speeches in the week ahead. Many of them were scheduled last week. This signals that the Fed is making a push to appease and answer questions from the public. Investors will be reading the tea leaves to see if they plan to accelerate any of their already stated plans. Now, the CME Group's Fed Watch tool showed that investors were pricing a 99% chance that the Fed will raise rates by 50 basis points in the March meeting. And this probability was 99% as of last Friday. To put it into context, on Wednesday, that probability was at 72%. So it was a 24% jump, actually 75%. So it was a 24% jump in the probability of a 50 basis point hike in just 2 days after the inflation number came out. So the market's speaking very clearly. Now, while the March FOMC meeting is just 4 weeks away, and this is the meeting where they will most likely announce their first rate hike, the Fed has 4 meetings on the calendar between now until the end of July. Fed members have expressed that they would like to see the overnight rate higher by 100 basis points between now and July, so by the end of July. This means that the Fed could still increase rates by just 25 basis points in every meeting from here until July and still get to the same target. Meaning that if the market is pricing in 50 basis points for the next meeting, there's a real chance that the Fed doesn't go all the way to 50. And basically, this divergence between the expectations and reality can create some relief for the market. But again, we'll continue monitoring this type of relationship and what investors are expecting from the Fed. So that was a very packed episode. There was a lot there to cover. We hope you enjoyed reading as always, and we're going to close out with a summary of exactly when and what is being delivered through the week. Tomorrow, Wednesday, 2:30 p.m. Eastern, we get the FOMC meeting minutes. This is going to be the minutes from the last Fed meeting. Investors will be looking to read through the tea leaves. Later on Thursday, we have 2 Fed speeches. 11 a.m. Eastern, we get St. Louis Fed President James Bullard. At 5 p.m. Eastern, we get Cleveland Fed President Loretta Mester. That's Thursday. And then Friday, we have an all-day Fed event at the Chicago Booth School, and that is the New York Fed meetings. So probably some headlines and comments will come out of there. And we have at 10 a.m. Eastern on Friday, we got existing home sales in the U.S. And at 10:15 a.m. Eastern on Friday, we get Fed Governor Christopher Wallace speaking as well. So we've covered a lot. Thank you so much for watching. If you enjoyed today's show, if you learned something, I welcome you to like it, thumbs up it, subscribe to our channel, and share it with your friends. If you don't have a Ledn account yet, I welcome you to check out ledn.io and learn how you can start earning the best interest rates for your USDC and your Bitcoin. And we also have the best loan rates if you need liquidity and don't want to sell your Bitcoin. And our most recent product, our Bitcoin mortgage, can let you buy a house as big as your stack. So thank you, everybody. Have a wonderful week, and see you next Tuesday.